Hi, my name's Tim Raes, founder and managing director of Aussie Expat Home Loans, the most trusted and reliable mortgage brokerage for expat Australians. Welcome back to our Expat Education Series. Today we're doing episode 4, the top 5 repatriation tips for expats that are going home. Today I'm again joined by my tax guru, Tristan Perry, managing director of tax and accounting at RP Private in Singapore. Tristan, thanks again for joining me. I appreciate it.
Thank you for having me.
So today we're talking about something that is very important, can be a little bit complicated, but something that we all need to be planning for eventually, and that's repatriation strategies for when we go home.
Exactly, very topical.
Yes. So there's 5 key points that we want to cover today, but I think just firstly, why is planning for repatriation so important?
So repatriation planning is super important for many reasons, including tax, cash flow, which are all kind of financial elements. So the main thing is we don't want to miss out on any opportunities, because after an expatriate assignment, we want to return in better shape than we left.
100%.
So this is what it's all about.
Yes, and I think also not being surprised by some of the things that can come up as well, which we'll get into.
Yeah.
So the first section I want to talk about, which again, talking about surprises for a lot of expats, is this is more of a specific Singapore item, but it's what we call the exit tax.
Yes,
of
exit
Singapore.
tax. Yep.
So maybe you can break that down.
Yeah,
first.
no worries. So look, it's we've all had a good time in Singapore or Hong Kong or other destinations, and some of us might be on what we call gyro plans. So we're paying our tax on an arrears basis. So the important thing we need to do is basically leave in good shape and true up everything that's owing to the Singapore government. So it's basically making sure that we pay our way, and sometimes in that exit tax calculation, you might have a situation where you're paying many months of the current Singapore financial year, which has ended 31 December, or the current Hong Kong financial year, where you've got many months of earnings, plus you've got a payment plan that you're paying off in the previous year, so that can sneak up on you. And for some other lucky expats, they're leaving with a number of unvested employee share scheme shares, and Singapore will tax you on the market value of those on exit of Singapore, even though you're not holding them yet. So that's an important cash flow factor that you need to just be aware of.
Maybe we'll just spend a couple of minutes just breaking down each of those taxes. So the first one is, obviously we pay income tax here. It's obviously a lot lower than when we go home, and we're on payment plans for that tax. So basically, when you leave the country, your employer will have to do a tax clearance for you, which essentially means any tax obligations that you have left have to all be cleared in one go. Otherwise, if you don't have tax clearance, you're not allowed to leave the country.
Yeah, exactly. Yes. So a situation where someone might be leaving in, for example, June, where you'd have maybe just lodged your Singapore tax for the calendar year ended 31 December, IRAS are yet to give you a assessment notice. So you've got basically 6 months of unpaid tax for the current year, plus you've got a payment plan that's running from the previous year. So all of that needs to be brought to account. So generally the time that you announce to your employer that you're going to leave, they're going to withhold 2 months worth of your salary to help true things up.
Correct. The bigger one, which is the one that catches a lot of people out, is the tax on unvested shares.
Yes.
So essentially, I'll try and break it down and you can tell me if I'm incorrect, but for a lot of people that get incentive payments up here, they get long-term investment plans which are paid as shares. And these shares can often have different vesting periods, often 2 to 3 years with most major companies. They're not counted as income until they're vested.
Correct.
But if you leave partway during a year, or you're leaving a country and you have a whole lot of unvested stock, the day that you leave Singapore, all that unvested stock becomes vested for purposes of calculating tax. So it's not vested, you can't sell it yet. Correct. It's still sitting there, you can't access it, but you're going to have to pay tax on
Correct.
it.
Yeah, which is my opinion. It's only fair because once you leave Singapore, you're effectively tidying up your affairs from a Singaporean point of view. A few important factors to add to your excellent explanation, Tim, was when they eventually do vest in Australia, they will be taxable, and you get to offset any Singapore tax you paid against your Australian tax. Also, if you have a situation where you change jobs in Australia and you miss out on the vest, so effectively the shares never vest, so you lose them, you do have the ability to write back to IRAS in Singapore and get a refund of that tax you paid.
Okay. Very important to know.
Yep.
Because a lot of people don't realise that.
Exactly.
The second topic, top tip number 2, cash flow planning for your moves. So for a lot of people that are going back, we've talked about taxes, but there's a lot of other costs that people need to be thinking about when they're going back, and they also need to be thinking about, okay, how do I plan for those costs? What are maybe some of the other costs outside of the exit tax that we talked about?
Yeah,
okay. To think about?
Well, really, and just briefly touching on that exit tax one more time to flow into the others, just remember that it's highly likely that you'll miss out on your last 2 months worth of pay as you're leaving Singapore. So this is something you do need to plan for. So it's not only the exit of Singapore, it's the re-entry into Australia. So, and we've got the obvious costs, which is things like, the moving costs to move into your property, cost to buy a car as well. That's obviously a big one. Cost to get your kids into school. If you're going into a private school in Australia, there's a bit of cost involved there. And most importantly, it's the Australian after-tax pay that you need to make sure you understand what that is as well, because that has caught out a lot of my clients who basically returned and they've said to me, wow, is this all I'm getting? And it's like, yep, because remember, Australia taxes you up front,
yes,
or taxes you as you go, so the pay-as-you-go system, as opposed to where we're lucky in Singapore, we get taxed in arrears. So in that situation, it is definitely a cash juggling exercise.
It's the biggest shock, especially for a lot of our clients that have been away for a long time, and you just get used to not seeing that on your payslip.
Exactly.
And then you go back and see, where did all my money go?
Exactly. And this is where the offset account can really help you. So
yes,
if you've got, for example, an investment property which has got an offset account, you can take money out of that offset account and use it for personal expenses, and it doesn't taint your investment property loan to make it non-tax deductible.
Correct. I think the biggest thing is just understanding what a lot of the costs are and modelling for them.
Yeah.
As well, because exactly like you said, quite often you lose your last 2 months of salary, so you need to have, you might get some of that back depending on the tax clearance and what those figures look like, but it's just important to understand what everything is and plan for it.
And an extra little tax element just to throw in there, which is a little bit off topic, but hey, I'm going to talk about it anyway because I talk about tax, is when you move back into your home, so let's say you've got an investment property that you're about to move back into, and let's say the tenants have damaged it a bit just through wear and tear. Maybe it needs a lick of paint or it needs some other repairs done to it. Providing those repairs are conducted within the same financial year that the property was rented, you can claim a tax deduction for those as well.
Good tip, very good tip. Because quite often, especially if you're going to move into it, there is going to be some work that has to be done to it. So may as well get some deductibility.
Some tax benefits from it.
Tip number 3. So the biggest thing people need to think about around converting loans and refinancing when they're going back. So I'll lead a bit of this, but essentially for a lot of our clients, especially if they've done the future family home strategy that we've talked about in the previous video, the loan will be set up as an investment loan initially. It's important to know that when you go back to Australia and once you start living in the property, you're eligible to be able to convert that loan into an owner-occupied loan. What does that actually mean? It just means we can get the interest rate down a little bit more. So typically owner-occupied loans will be 0.2, 0.3% lower compared to an investment loan. And it's normally a relatively easy process for us to convert those loans over. For most banks, it's just showing them some evidence that you're living in the property now, change your driver's license, address, utility bill, and we can convert it pretty quickly for them. I always tell my clients, especially if you're going home with your employer and you have employment straight away, it's good for us just to have the refinancing conversation and just see what other options are out there, because the options for us to borrow as expats are obviously much more limited compared to when you're living back home.
Yeah, and I feel that probably in the last 5 or 6 years, refinancing is definitely a lot cheaper and a lot easier to do, and yourself and your team make it as easy as possible for the paperwork grab.
No, it's look, when we do things that are offshore, it's a lot more manual. Our loans for expat loans do take longer. It's a lot more paperwork. When you're living back home, quite often we can have approvals within 1 to 2 days, and we can do a refinance within 2 to 3 weeks, because almost everything is DocuSign. You're living in Australia, it's a much easier story for us to tell the bank. Little plug for me and my business, we have an office in Melbourne now where our clients back home can be looked after locally as well. So I just tell everyone, when you're going back, just let us know, because we have a lot of options to review, especially if you're going back and you have employment straight away. I just want to talk, we talked a little bit about it in our previous video, but debt recycling is something that I've been talking to quite a few clients about lately. So debt recycling as a concept, it just means, especially if you, again, have followed the Future Family Home Strategy video that we talked about last time, you have bought a property. It's an investment property when you've purchased it offshore, but you're moving back into it when you go home. You now have a loan against that property that's not deductible for tax purposes. The goal of debt recycling is to turn that loan from a non-deductible loan into a deductible loan without having to go through a lot of the rigmarole and paperwork of reapplying and refinancing. So in the previous video, I talked about redraw versus offset. Debt recycling essentially means you will take your loan that's against your home. It's not deductible anymore, but you pay it down to $1. You then redraw that balance back out again and use those funds for a tax deductible purpose. So that could be purchasing an investment property, going into the share market, purchasing other listed investments, anything that's a new investment purpose. That loan converts from a non-deductible loan into a deductible loan. And any interest on that loan, you can start claiming against income that's being earned for that purpose in Australia.
Yep, definitely well summarised, Tim. And that's it's becoming a more common situation where clients will collect investment portfolios offshore, sell them capital gains tax-free and income tax-free just before they head back to Australia, take the cash, pay down the loan to $1, and then when they're back in Australia, they draw the cash back out of the loan, which resets the purpose of that loan. As you'll recall from our previous discussions, ATO always follows the cash.
Yes.
So where does the cash go? And then use that for income driving purposes. So hence the loan will be tax deductible. So yeah, great strategy.
It's just very important to get advice before doing any of that, because like all things in Australia, it can be a bit complicated, and you really want to make sure that if you're moving the money through the accounts, you're buying a new investment, you need to make sure that it all lines up correctly for tax purposes.
Yeah, and it's making sure that you actually do pay down that loan and draw it back up. Again, you don't just put the money in the offset account and take it out again. So advice is important for that transaction.
100%. Tip number 4. When do you become a resident for tax purposes? Probably the second most hot topic that you get.
Yeah, this is a good one. So for a little bit of context, so the Residency Rules basically still the old original Residency Rules that we've had since the 1936 Tax Act. There's been no changes to that at the time that we filmed this video, Tim. So, and there's potential changes coming down the pipeline, but at the moment, let's talk about the current Residency Rules. So the current Residency Rules, we've got the resides test, the domicile test, and the 183-day test. So a lot of clients will just say to me, I'm not in Australia for 183 days, I've got nothing to worry about. Sadly, that's not the case. So when we're looking at returning to Australia, the Australian taxman is looking at, for example, are you going as a family unit? So is it spouses and kids? Are they all going together, or is it staggered? Is one spouse going at a different time to the other? And that can affect your residency position. Have you always got a house offshore that's available to you? So in the sense, technically speaking, under the domicile test, if you're an Australian citizen and you do not have a place to live offshore, i.e. you've given back up your Singapore rental property and you're living out of a hotel, technically speaking on that day, you move back to Australia. So if you do have a few, for example, bonuses that are coming through or any other taxable events that you want to receive in Singapore and not have them tainted by Australia, you want to make sure that you keep a home available to you in Singapore up until that point. But generally speaking, with most expats, when they pack up their affairs in Singapore, they put their furniture back in a shipping container, send the dog back and the cat potentially, and then basically jump on that plane and fly back together. From that day onwards that they land in Australia, they become a resident from that day onwards. So, and it's generally not the whole year, it's from that day going forwards.
I think, look, we talk about a lot, getting advice is really important. I see it a lot now where two spouses are working, one of them either loses the job or they're just planning to go home, and one quits before the other and the other has a bit longer to move back home. The rules can be different for different individuals as well, right? So, and the positions can be different for both of them. as well. So it's not just homogenous between the two parties that go home, and timing is everything. So
timing is everything. So it's one of those things that the rules are complicated. There's a lot of grey space, unfortunately, which is the reasons why the government is attempting to change them to a much clearer test, which will make this a very easy segment to talk about. But at the moment, very specific to each individual circumstances. And if you are in a circumstance where one of the two spouses is going home with the kids ahead of the other, you definitely need to take advice just to make sure that the spouse remaining in Singapore, generally for reasons of bonus or salary or whatever, continues to maintain their non-residency position.
Where we see a lot of clients get into trouble is where one spouse has gone home and one's still working overseas. So I've been in Singapore for 9 years now, and the stories that I hear about people that get letters from the ATO, it's always the wife and the kids are home, or these days the husband and the kids are home and the wife's living and working overseas still. There are certain boxes you need to tick to maintain your tax residency overseas if your family's living back home.
Exactly. They say you're definitely in danger when you have a spouse and a house in Australia. And a house is basically defined as a place to live. So, when you're a non-resident, if you have a house that's been rented out, that's not available to you to live. So if there's a house that's in your name, but it's got a bed there that you can technically sleep in it whenever you want, and your wife and your kids are back there, or your husband and your kids are back there, then it's a situation where your day count comes all the way down to possibly more like 45 to 50 days per financial year.
Yes. The last section to go through, last tip to go through is, we've talked a lot about capital gains on property, but actually the capital gains rules for shares are very different when you're offshore, in a good way.
Yes, they are.
So why don't you break down the rules?
Yeah, okay, so let's talk about coming to, basically leaving Australia and moving offshore. So in that financial year that you leave, so you'll be a part-year resident, you get the opportunity to have a deemed sale on any shares that you hold. Now this does not extend to Australian property. So Australian property, because it's fixed to the earth, always taxable in Australia. So shares, you can have this deemed sale event where you can elect to sell all of your shares at the market valuation for tax purposes and bring them offshore with you, which means from that point onwards, they'll be capital gains tax free going forwards. Now, any shares and investments that you collect whilst you're offshore are capital gains tax free during that time. Then you have a situation where you're about to go back home again. Then those shares, if you keep them, they take a market valuation on the day that you're about to set foot in Australia. And then from that point onwards, they're subject to tax, including the 50% capital gains tax discount. That also comes back on the table. And a lot of people say to me, do I need to sell it before I come back and rebuy it back? And the answer is no, you don't, because it takes a market valuation when you come back. There is a slight consideration with the 50% capital gains tax discount. So generally I say to people, if you're looking to sell the share within 12 months of returning back to Australia, you might consider not selling it, so just holding on to it. But if you're going to sell it after 12 months of coming back to Australia, you might sell it and rebuy it back, or even consider putting it in a family trust or something like that, because you'll get a better access to the 50% capital gains tax discount.
I think again, it's when I first moved here, I got not necessarily burnt by this, but it just wasn't something I was very aware of, because it's, anyone that comes here gets advice. They're very aware that they need to get a valuation when they go back normally, because their advisor will tell them.
Yep.
But for a lot of people that held investments before they arrived here, if you, again, stay here for 10 years and then you're trying to get what a market valuation was on a share 10 years ago, it's often very difficult to get those records and keep them. So,
correct.
Again, it's important. A lot of people, especially if they're investing in shares, if they have an advisor, they can talk to them about this. But if they're self-directed, you need to be able to keep records of what certain prices were on certain dates. And
there's definitely a bit of strategy around, whether you keep it in your own name or you move it to another entity, be it a family trust, a company, a spouse's name, or a super fund. When you're back in Australia, there's definitely some strategy around that.
Yeah, but the short recap of that point is basically investments in Australia, capital gains taxable. When you're offshore, not capital gains taxable in Australia.
Correct.
And then it depends on the country that you live in.
Exactly, and providing you disconnect them from Australia for tax purposes as well.
Yes.
Is very important.
For sure. Okay. Thanks so much for your time, Tristan. Appreciate it.
Appreciate it.